Are you tired of paying taxes on Social Security benefits you already paid taxes on once? What if I told you that Congress just introduced a bill that could eliminate those taxes completely starting in 2026? I'm talking about real money here. If you're currently paying federal taxes on your Social Security, this could save you hundreds or even thousands of dollars every single year. But there's also some confusion out there about what's already changed and what might change. So let me clear that up for you. Today, I'm breaking down the You Earned It, You Keep It Act, a new bill that could end Social Security taxes forever. Plus, I'll explain the new tax deduction you can claim right now and why some people are getting the wrong information about what's already been passed. Comment below and tell me, are you currently paying federal taxes on your Social Security benefits? Because what I'm about to share could change everything for your retirement budget. Let me start with what's happening right now. Millions of retirees are paying federal income taxes on up to 85% of their Social Security benefits. Think about that for a moment. You paid payroll taxes on your income for decades. Then when you retire and start collecting the benefits you earned, the government taxes you again on that same money. It gets worse. The income limits that trigger these taxes haven't changed since 1984, not 2004, not 1994, 1984, when Ronald Reagan was president. Back then, only 10% of Social Security recipients paid any federal taxes on their benefits. Today, that number has jumped to 56%. More than half of all retirees are now paying these taxes. This isn't because benefits got more generous. It's because inflation pushed your income higher, while the government never updated those 40-year-old limits. It's called bracket creep, and it's been quietly affecting more retirees every single year. Here's how those outdated limits work today. If you're single and your combined income exceeds $25,000, you'll pay taxes on up to 50% of your Social Security. If it exceeds $34,000, up to 85% becomes taxable. For married couples, those numbers are $32,000 and $44,000. Again, these are the same thresholds from 1984. Combined income includes your adjusted gross income, plus any tax-free interest you earn, plus half of your Social Security benefits. So even if Social Security is your main income source, you could still owe taxes. Let me give you a real example. Say you're single, getting $2,000 a month in Social Security. That's $24,000 per year. Half of that counts toward your combined income, so that's $12,000. If you have just $13,000 from other sources, maybe a small pension or 401k withdrawals, you've hit that $25,000 limit. Now, you're paying federal taxes on money you already paid taxes on when you earned it. For a married couple, both getting Social Security totaling $3,000 monthly, half of that annual $36,000 is $18,000. Add just $14,000 from other income sources and you're paying taxes on your Social Security. This is why so many retirees get hit with tax bills they never expected. They planned their retirement assuming Social Security would be tax-free, only to discover they owe hundreds or thousands in taxes they never budgeted for. The unfairness goes even deeper. You're essentially being penalized for being responsible and saving for retirement. The more you saved in 401ks and IRAs, the more likely you are to exceed these thresholds when you start taking required distributions. But here's the breaking news. On September 4th, Senator Ruben Gallego from Arizona and Representative Angie Craig from Minnesota introduced the You Earned It, You Keep It Act. This bill would completely eliminate federal taxes on Social Security benefits starting in 2026, not reduce them, not raise the thresholds, eliminate them entirely. Senator Gallego put it bluntly. Trump claimed he ended taxes on Social Security. My bill actually does it, permanently. If this bill passes this fall, you'd see the benefits when you file your 2026 tax return in early 2027. Now you might be wondering, how would they pay for this? Because eliminating Social Security taxes would reduce federal revenue by about $50 billion annually. Here's their solution, and it's actually quite fair. The bill would raise the Social Security payroll tax cap from $176,100 to $250,000. Right now, if you earn $200,000 per year, you pay Social Security tax on every dollar. But if you earn $2 million per year, you only pay Social Security tax on the first $176,100. The remaining $1.8 million is completely exempt. Think about how unfair that is. A teacher earning $60,000 pays Social Security tax on 100% of their income. A Wall Street executive earning $600,000 only pays Social Security tax on about 30% of their income. This creates a situation where middle-class workers often pay higher effective Social Security tax rates than wealthy individuals. It's a regressive system that hits hardest on people who can least afford it. This change would make high earners contribute more to the system everyone depends on, and according to projections, it would extend Social Security solvency from 2034 all the way to 2058. That's nearly 25 more years of guaranteed full benefits. This addresses two problems at once: unfair taxation of retirees and Social Security's long-term funding challenges. So what could this mean for your wallet? The savings could be substantial. If you're single with $30,000 in combined income and $24,000 in Social Security, you might save $300 to $600 annually in federal taxes. For a married couple with $50,000 in combined income, including $36,000 in Social Security, the savings could be $2,000 to $4,000 per year. Higher income retirees would save even more because more of their Social Security becomes taxable under current law. Think about what that money could mean for your retirement. An extra $2,000 to $4,000 per year could cover increased healthcare costs, help with home maintenance, or simply provide more financial security and peace of mind. But I need to be honest with you about something. While this bill addresses a real problem and has growing support, major changes to Social Security taxation are never easy to pass through Congress. The political process is complex. Different parties have different priorities for tax policy and Social Security reform. Getting consensus on major changes takes time and political will. There's actually a competing proposal called the Retirees First Act from Senators Marsha Blackburn and Roger Marshall. Instead of eliminating Social Security taxes entirely, it would raise those outdated thresholds to $34,000 for singles and $68,000 for married couples. This approach would provide significant relief to middle-income retirees while still collecting some revenue from higher-income beneficiaries. It might be more politically feasible because it has a smaller impact on federal revenue. Both approaches have merit, but they represent different strategies for providing relief. The Gallego-Craig approach is comprehensive but eliminates more federal revenue upfront. The Blackburn-Marshall approach provides targeted relief while maintaining some revenue collection. Both are vast improvements over the current system that hasn't been updated since 1984. Now let me clear up some confusion that's been spreading. Some people received emails suggesting that President Trump already eliminated Social Security taxes. That's not accurate. What Trump did sign in July 2025 was a tax bill that includes a new senior bonus deduction. This gives you up to $6,000 extra deduction if you're 65 or older, or $12,000 for married couples where both are 65 or older. This deduction can lower your overall tax bill, and it's available right now through 2028. But it does not eliminate taxes on Social Security benefits. It's a helpful benefit, but it's not the same as ending Social Security taxation. Make sure you're getting accurate information. Misinformation about Social Security changes can lead to poor financial planning decisions. The senior bonus deduction works by reducing your taxable income, which could lower your overall tax burden. But if you're paying taxes on Social Security benefits, those would still be taxable unless the "you earned it, you keep it" act becomes law. So what should you do right now while Congress debates these proposals? First, understand your current tax situation completely. Calculate your combined income carefully. This includes half your Social Security plus all other income, including tax-free municipal bond interest. Many people don't realize that municipal bond interest, while exempt from federal income tax, still counts toward their Social Security taxation threshold. Second, look into that new $6,000 senior bonus deduction I mentioned. If you're 65 or older, you can claim this starting with your 2025 tax return. It's available through 2028 and could save you money right now under current law. Work with a tax professional to make sure you're claiming all deductions available to you. The tax code is complex, and many seniors miss out on legitimate tax savings. Third, consider tax planning strategies that work under current law. If you can control when you take retirement account withdrawals or realize investment gains, timing these around Social Security tax thresholds could save you money. For example, if you're close to the threshold where 85% of your benefits become taxable, it might make sense to spread large withdrawals over multiple years rather than taking them all at once. Fourth, stay informed about both pieces of legislation. The You Earned It, You Keep It Act could save you thousands annually if it passes. The Retirees First Act could provide significant relief while being more politically feasible. Track their progress through Congress. These bills will go through committee hearings, markup sessions, and floor votes. The process can take months, but the outcome will directly impact your retirement budget. Fifth, contact your representatives in Congress. Whether you support complete elimination of Social Security taxes or prefer raising the thresholds, your voice matters. Congressional offices track constituent contacts on these issues. When you contact them, share your personal story. Explain how current Social Security taxation affects your retirement budget. Real stories from constituents carry more weight than generic policy arguments. Remember, this isn't just about tax relief, it's also about Social Security's long-term health. The current system is projected to face a funding shortfall by 2034. Without changes, benefits would be cut by about 20% across the board. The Gallego-Craig bill would solve that problem while providing tax relief. It's a comprehensive approach that addresses multiple challenges facing Social Security. The political momentum seems to be building. When only 10% of beneficiaries paid Social Security taxes in 1984, it wasn't a major voting issue. With 56% affected today, it's become a priority for millions of voters. The demographic trends support change too. As baby boomers continue retiring in large numbers, more Americans are discovering they owe taxes on Social Security benefits they thought would be tax-free. The broader economic context matters as well. With inflation having eroded retirees' purchasing power over recent years, tax relief on Social Security benefits could provide meaningful financial assistance to millions of older Americans. This isn't a partisan issue at its core. Republicans and Democrats both have constituents affected by Social Security taxation. The challenge is agreeing on the specifics of reform and how to pay for changes. The bottom line is this: after 40 years of more retirees getting caught in an outdated tax system, Congress is finally considering real reform. The question isn't whether taxing Social Security benefits creates problems. Most people across the political spectrum agree it does. The question is what solution Congress can agree on and when. Keep this in perspective. You paid into Social Security your entire working life. You earned these benefits through decades of contributions. Having to pay federal income tax on them again feels fundamentally unfair to most people, regardless of their political views. The current system creates perverse incentives. It discourages saving for retirement because additional income can trigger taxes on Social Security. It penalizes responsible financial planning. Change appears to be coming. Whether it's complete elimination of these taxes or significant increases to those 1984 thresholds, relief could be on the way as soon as 2026. For now, plan based on current law, but stay informed about these developments. The outcome could significantly impact your retirement budget and financial planning strategies. Consider this an opportunity to review your overall retirement tax strategy. Even if Social Security taxes are eliminated, you'll still need to manage taxes on other retirement income sources. If this information helped you understand what's happening with Social Security taxation, hit that like button. It helps me reach more retirees who need this information. Subscribe and turn on notifications because I'll be tracking both of these bills as they move through Congress. The next few months could determine whether you'll be paying federal taxes on your Social Security benefits for years to come, or whether 2026 will be the year those taxes finally end. Share this video with other retirees who might not know about these proposals. Knowledge is power, especially when it comes to your financial security. And comment below, let me know if you're currently paying these taxes and what ending them would mean for your retirement budget. I read every comment, and your experiences help other viewers understand how these changes could affect real families. Thanks for watching, and I'll see you in the next video with more updates on changes that affect your retirement security.